It's time for Money for Lunch, where we feed your brain and your business with supersized portions of business and financial news. Now your host, Bert Martinez.
All right, we are back. My next guest, Stephen Devlin. Stephen Devlin is leading expert of Bank on Yourself and the infinite banking concept in Canada. He's passionate about helping clients become financially self-empowered and set for life by educating and coaching them on key principles that put them in control of their money and create long-term financial stability and security. Stephen Devlin, welcome to Money for Lunch.
Wow, thank you. What an honor and privilege. Thank you, Bert.
You bet, you bet. Let's talk about this. I want to get your opinion on this. What is the biggest mistakes people make with their money today?
Well, I think for me personally, it was just not having a clear direction of where I wanted to put my money. And I think that we get brainwashed with a lot of other things out there that sound enticing but sometimes don't work out well. And I think that, you know, whether you're in the U.S. or in Canada, around the world, I mean, I think people are very good at making money. I think people are good at spending money. I know I like to spend money.
Sure.
But does it come down to saving? You know, how well are we saving our money? And I think the biggest mistake is that we get caught into this instant gratification society of easy credit, needing to get whatever we want instead of learning what our grandparents or great-grandparents learned was don't buy something unless you have the money. You know, that's awesome Saturday Night Live skit with Steve Martin, you know, is that do I really need to have the money? Can I not just use my credit card? So I think that's one of the biggest things is keeping up with the Joneses and trying to say, you know what, I need this, but is it a need or a want, and discovering, you know, what do you want to do with your money?
Yeah, absolutely. Well, you know, and I think one of the mistakes that I made early on is that I did not, you know, when you're young and dumb,
Yeah.
which is you know, it's not always a good combination. It's never a good combination when it comes to money. You know, first of all, you think you're too young to think about retirement.
Mm-hmm.
And then, of course, when you start thinking about retirement, then you start thinking, man, I wish I would have done it when I was young and dumb, right, when I was much younger. And so one of the mistakes I remember making, and I really harp on my kids to make and anybody else, is to start thinking about your money now. You know, take some time to understand about how money works now. If you're 20 and you're listening to this, you're thinking, man, I'm so young, I don't need to worry about retirement. Within just what's going to feel like just a few minutes, you will be 40, and retirement will be right around the corner.
Well, you know the old pyramid, right? So the pyramid is about building a platform, a foundation. The problem is we get caught into flipping that pyramid on the other end and looking at creating this high-risk investment to create as much return as we can, but knowing that, you know what, if I can't work tomorrow, what's going to happen? Do I have 6 months of emergency money? Do I have that foundation? Do I have the protective expenses in place, such as life insurance, critical illness, disability, right?
Right.
Those are the things that we need to learn, is creating that pyramid the right way and creating your foundation first and foremost. So that's one of the big mistakes, too, we make, is we get caught into, you know, having that, water cooler discussion and, you know, what's the biggest stock tip or how can I get this great return? And then all of a sudden it's tanked. And then you know, that's one of the mistakes I made is following that pattern, right?
Absolutely. You know, and it's so funny, too. It took me a while to realize this. By the time you and I hear about some fantastic stock deal, the guys that got in it are already getting out of it.
I know. It's kind of funny. I mean, I think the key is with your money, it's got to make sense to your values around money. You got to know values. I mean, is what's important to you about your money. What is your value around money? Is security a value? Certainty. Is it being able to provide for your family and your children? Is it to be able to have money for, you know, long-term care? Or, you know, one value is for me was having opportunities. You know, we lost a lot of money in a bad business deal. It didn't work out well for us. It was a difficult time for our family, and we were facing bankruptcy or consumer proposal. And guess where we went? We went to the bank for help, and obviously you know what the bank does, right? The old Mark Twain quote, they'll give you the umbrella when it's sunny, but then take the umbrella away when it's raining, right?
Yes.
while we were left like with no one to help us. So we had to figure out another solution. We had to, think about what can we do to get out of this, because we didn't want to go bankrupt, and we weren't going to, and we never did, which is a huge thing that we did together, my wife and I, to figure out a better way. And that's where that bank on yourself strategy, infinite banking strategy, came into place for me from one of my mentors down in Missouri. Told me about this stuff, and I was blown away that I didn't know about it, and quite frankly kind of angry that my advisor didn't tell me this, and was really the reason why I actually got licensed into the industry, to teach people, what I had to learn the hard way.
Absolutely. Well, okay, so let's talk about this a little bit more. I want to get your opinions on this because, again, you and I have, we sound to be about the same age, probably have,
yeah, I just turned 50 in December 29th.
Oh, there you go.
I turned 50,
I'm 53, so yeah, we're right there. So what do you see? What are some of the common myths that people fall for when it comes to money or wealth that prevents them from achieving financial success?
Well, I think the biggest myth is that you have to take on volatility and you have to take on risk to get ahead. But I'm a believer that the turtle will win the race, right? Slow, steady as you go, not get caught into the get rich quick, but, get rich steady. So that was one myth. Another myth is the accumulation myth. The reality is cash flow is king, and cash flow is something you need today. And when opportunities come your way, for us in the past, we weren't able to take advantage of those opportunities because we didn't have the money to do that. So that was also a big myth, is the big accumulation myth as well, and taking on that risk for sure are some myths that people have to realize in their life is, what are the goals that you have financially? Think about the goals that you have that require money to achieve. What's going to take to have those goals become a reality in your life? Falling along the myths around money is going to have, unfortunately, some dire issues later on, not being able to achieve that financial success, right?
Right. Yeah. And you know what? There's always this love-hate relationship when it comes to money for a lot of us, and there's this confusion. And so, money is not as important as, let's say, health. It's not as important as love. It's not as important as spiritual things. But money is the most important thing when it comes to money. I mean, and really, our world revolves around money. So if you want to have a peaceful retirement, you need money and lots of it. If you want to be able to put your kids through college, money. Yeah. If you want to be able to support their wedding in a favorable way, money. If you want to take a nice trip, money. If you want to celebrate special events, money. So, just so we get it straight, money is the most important thing when it comes to money, and probably the most important thing that comes when it comes to these to worldly things. But it's yet, we all know people who would gladly give all their wealth away to have a healthy body.
For sure.
And things of that nature. And I don't want to be one of those guys who, yes, I've accumulated $1 billion, but I've been divorced, 5 or 6 times. I don't want to be one of those guys. So it's not as, it's not as important as a few things, but man, it's in the top 4 or 5 things. It's pretty important.
It is, but it's an exchange of value, right? So,
yes.
It's not happiness that money will do. It's, what's going to happen when you do that process, having those dollars to have that experience with your family, to go on that vacation, to be able to invest in your business, right? So,
right.
That's really comes down to some of the myths. Money is power. I think that's a big myth as well, that, money is going to make you more powerful, more happy. It's not. I mean, money is a byproduct of lots of different values you create in your life, right? So,
yeah.
And, debt, also avoid debt like the plague is another big myth, right? So we've been always taught that debt is bad, but sometimes some debt is good. And to really understand in your life, what are the destructive expenses in your life, and avoid and get those out of the equation, so you can understand, what's going on with the good debt. And, hey, all day long, if there's an opportunity to get some money to improve yourself financially, perhaps as your business is growing, that's good debt. Your home, potentially is good debt, right?
Yeah.
So I think that's
absolutely.
also a big myth too. So,
it's funny too. I want to talk about the myth of debt. So I agree with you. First of all, there's good debt and bad debt, and I think a good example, and this is my opinion. I'd like to get your feedback on it. We all have to buy a car, and most of the time we have to buy a car on some kind of, we have to finance that vehicle. When you're buying a newer vehicle. So let's say that you're going to buy a car, and financially you could easily afford a $100,000 car. Yeah. Buying a $100,000 car, whether you paid cash or you're financing it, to me is bad debt, is a bad investment, because it's a car, it's a depreciating value so quickly. It's not an asset, and not a real asset. As opposed to, let's say you can afford a $100,000 car, but you choose to buy a $20,000 car or something like that, something that's so below your means that you can easily pay for it. Maybe you don't even have to finance it. But my point being is that to me is an example of bad debt. Is getting into a car, especially a car you cannot afford, is bad debt. One of the things that I learned, and I wish I would have learned this earlier in life, Robert Kiyosaki's book, Rich Dad, Poor Dad, he talks about good debt and bad debt. And he also talks about his definition of an asset that he had learned from his rich dad. And so an asset is something that makes you money, period. And when I started looking at that, a car doesn't make you money. Even the house that you're living in probably doesn't make you money. Now, again, I'm not saying don't buy a car and don't buy a house, but what I'm saying is look at it in a different point of view. And so it's because if you start looking at things with a different mindset, you start making different decisions, don't you?
Better decisions. And you think about, that extra 20, that extra 80 grand that I would have put into the car can, buy that $20,000 car you mentioned and maybe make that 80,000 work and grow as an asset, right?
Right.
We get caught on that stuff all the time, and the interest that we pay in our lifetime is tremendous.
Yeah. Yeah, and matter of fact, absolutely. One of the traps that I again, when I was young and dumb, that I would get into is that you think that having a flashy car, a flashy house, and flashy clothes, prove, this is stuff that you do to prove to other people you're successful. It's what do you call it? Once you realize that those things are really unimportant, that they're trivial, then it changes. It really changes things. What do you call it? Again, I'm not saying you shouldn't have nice things, but you shouldn't buy nice things to impress other people, right? It shouldn't be a status symbol. Again, this is bad debt. And I mentioned mindset a little bit ago, and I want to kind of pick your brain on this. What does having a healthy money mindset look like for you? What does that mean?
Yeah, for me, that looks at having a conscious spending plan. It's values-based spending. I don't really like the word budget because it's built on scarcity instead of abundance. So I think having a healthy mindset is looking at your cash flow, having that weekly or monthly family meeting to discuss finances, because women and men look at money differently, right? And that's a huge part of a lot of divorces, right, is money. So, looking at your home, your financial commitments, starts with looking at kind of like a business and having that fiduciary duty to look at your money smart, and having that mindset of, it's healthy. We have these goals we want to achieve. We're starting to save. We have those commitments. We're teaching our children being good stewards of our money. We're teaching them how to, become our own bankers in a way and learn how to save our money and not interrupt the growth of our money when we do need things. That's a healthy mindset. Having money flow into an account that you use for, guilt-free spending, for splurging. And, allocating money for certain things creates that healthy mindset financially, to know that you'll have money later on and you'll have money in emergencies is huge, and you'll have money to give to others if that's important to you as well. That's all having a healthy mindset, I believe.
Sure.
And being smart,
like
being educated, reading books, getting an advisor that's going to help and guide you and also challenge you and give you some tough love when it comes to your money to make sure that you're on line to achieving those goals, right?
Yeah, and you know what? And I want to emphasize something you said about not disrupting or interrupting what do you call it? Investments to
the growth of your money. Yeah.
The growth. Yeah. So I'll give you a personal example that just happened to us. Let me cough first, and I'm back. So we just made this terrible tax mistake last year. So now we got to pay for it this year, and it's going to cost me the tune of about $10,000.
Mm-hmm.
Big mistake. And so my wife said to me, "Why don't we just take it out of our retirement account,
401k, or out of a
401k that we have?" And I said, "Honey, that would be like that'd be like double dipping on penalty and interest. That's the worst thing we could do. When we could manage the IRS debt, I mean, we'll figure it out. We'll make a couple of payments, but it's no big deal. I mean, I can negotiate the interest and the penalties and stuff like that. But once you start disrupting your growth, taking $10,000 out of your 401k to pay off any debt is a horrible thing to do. Talk about taking debt and turning it into bad debt, right? And this is something that I probably would have done if I was, let's say 20 or 30. But once you start understanding the power of compound interest and not disrupting that money growth, I'm not even slightly interested in doing anything like that, So
well, yeah, I mean,
go ahead.
Can you imagine, though, if you had a vehicle that would allow you to do that, to take money out, but allow it to continue to grow, just like your home? Your home grows, right? If you take a line of credit on your home, it's still going to grow, correct? You know what I mean? It's an asset that grows, and, hopefully the market increases, not like '08, of course, but, that's what we do with this strategies. We learn to be in control of the banking functions in our life, and if we do need capital for things, because life does happen, such as that IRS bill or up here at CRA, you need to have money to do that. You don't want to take it out of savings or your 401 or our RSP up here. So, there's a way of doing it through the Bank on Yourself concept that allows us to continue to grow on our money, but also access the capital. So basically, take the money and still get credited and compounding and dividend on 100% of it as if you hadn't touched a dime of it. Was really appealing to me when I learned about this back in '08 and '09 during that bad times that we had financially, right?
Sure.
So that's what we're teaching people.
Let's talk about this a little bit more because I know a little bit. I had one of your compadres on the show. And
one of my compadres, Dale.
Anyway.
Dale.
Dale, thank you. Yeah. So I know that part of this is it's a insurance-backed annuity something. So why don't you explain the concept and how it works?
Yeah, it's an asset that, funny enough, has been around a long time, 160 years. It's a dividend-paying whole life insurance contract that grows by contract every single year. Has never lost money in the history of this, but it's not like the old whole life that our grandparents or great-grandparents had where it was slow growing. This is a high cash value hybrid, same kind that the banks have truckloads of this. There's a book called Pirates of Manhattan, and there's a chapter in there called BOLI, Bank-Owned Life Insurance, and it shows how much of the banks actually have in this stuff. Why? Because it's guaranteed, because it's predictable. It's accessibility is critical on this because it's there available, because we're leveraging our life, we're leveraging our health. And because we're living longer and we have a nice time horizon, this thing's going to grow and get better every year, just like, an airplane takes off and the fuel falls off, right, burns off, becomes more efficient. It's the same as this. So I don't really care if I'm getting 7 or 8% today, frankly, because I'm not retiring today. Obviously, I do later on down the road. But during the buildup of this policy, we're able to access it as of day one to finance life's needs, to buy that car and still grow on our money, to help a family member, to buy a home, to start a business, to help our children with their education. And it's fascinating because, at 43 years old, I wish I'd known about this earlier, because it would have helped me out tremendously during the bad times to understand that I can access this money with no questions, no credit checks, no proof of income, no hassles. It's so free. It's peaceful. It's a way of banking that, people don't know about. So, I mean, the wealthy do. The wealthy all have truckloads of this stuff too. What we're trying to teach, the average, American and Canadian middle income earners, that there's a better way to help manage your cash flow, and it's not about replacing investments, not about replacing stocks, if that's what you want to do, or real estate. It's a place to store your wealth, and a place that's safe and secure and guaranteed, that gives you that predictability down the road. And, life happens, you've got money. So that's what we live and breathe, and why we teach this, and why I got involved in this, to teach others what I learned and how it saved our bacon, and that we've been saving money all these years now, and our wealth has only been going up and up and up and up. So,
now, okay, so real quick, so
yeah,
it is a life insurance?
Insurance, yeah, it's a life insurance contract with a mutually owned insurance company, meaning that the policyholders are the owners, and it's a life insurance contract, but it's whole life, dividend-paying whole life. Dividends have been paid for over 100 years in a row.
Now,
and you become an owner of the company, yeah.
Okay, so and this is not like you said earlier, this is not your typical life insurance policy. This is something that's different, and so not everybody can sell this type of policy, right?
Yeah, I mean, like your life insurance broker certainly can tell you, yeah, I can sell you a whole life, but this individual, maybe 1 out of 1,000, have had the necessary training, like myself and others who are licensed in this, to understand the specific riders we put on this, to understand how we want to put more money in to help it grow exponentially and really make it most efficient as possible. And if we compare this to other investments, this thing will come out really nice down the road. I mean, you're going to get 5-6%, and that's good, because it's not always about rate of return. It's about making sure you actually have money later on. And you've got so many tax advantages with this vehicle that the other things just can't even compare. It beats the pants off the other ones when it comes to tax advantages and the guarantees that it has. And, it's, like I said, it's not get rich quick, but it's get rich steady, and it's all about making sure you've got money down the road when you need it, and also now for your family and for things that come up.
Now, okay, so let me ask you this.
Yeah.
This is Bank on Yourself. This is a certified program that really, if somebody wanted to know more about this, like if you're in Canada, obviously you're the guy. Your people could go and talk to you. If you're in the U.S., you want to look up somebody who's certified in Bank on Yourself. Is that correct?
Yeah, there's about 200 advisors that are licensed in North America. Bank on Yourself has been around since 2002. So yeah, definitely the website is bankonyourself.com. That's the best place to go and learn about it. And then if you're interested in getting a no-obligation analysis for the listeners out there, we want to provide some value. That's a no-obligation way of actually checking this thing out. And then an assigned Bank on Yourself advisor, whatever state you're in, will be in contact with you to kind of just talk a little bit about what's going on for you financially. And these individuals are like myself. They look out for your long-term needs. They're financial advisors. They can help you with your debt and other issues that are going on financially, and creating, a really healthy mindset around money, and to teach you this. We're all about education, Bert. This is all about education, not selling. It's about people doing their due diligence, learning the stuff that's out there on this, and questioning it, and just don't take it for face value. Dig into this and know that it's really good. It is very good, and it's helping a lot of Americans and Canadians. So,
I love it. Hey, Stephen, we're out of time, but this has been a lot of fun. And again, if you guys are interested in finding out more about Bank on Yourself, you can check out Stephen Devlin. And if you're in Canada, what's your website there, Stephen?
We've got some great videos on our site, Mac Dev Financial. That's www.macdevfinancial.com, and click on resources, and there's some great videos on there too.
I love it. Stephen Devlin, thank you so much for stopping by and sharing.
Thank you. Appreciate it. Bye for now.
Good stuff there. Not only on, we talked quite a bit about a healthy mindset, good debt, bad debt. There's a lot of good nice little nuggets. As always, we're so glad that you stopped by here. We appreciate the fact that you tweet and Facebook and share the show. We're grateful for your listening and for your support. Remember, you were created to succeed.
Tune in Monday through Friday here on Money for Lunch and check out our website at moneyforlunch.com.